Good morning. My name is Seth, your Metro Detroit real estate expert, and with me, as always, your mortgage expert, Steve Frost, on this beautiful Thursday morning, June 20th. How are you?
Fabulous.
Terrific.
It's a good
All
day
right,
today.
right
The air
in.
conditioning works. My office, the air conditioning's been messed up all week. It's been like 85 degrees in here. I've been working at home in my basement where it's like 12 degrees. I've had a space heater on. So it's okay. Trying to
That's
find a
funny.
balance.
That's awesome. All right, dive right into the mix. So for this week, I'm just going to keep hammering the points that I've hammered the past few months because now the news that's coming out is stuff that Steve and I have been somewhat predicting and starting to talk about the trajectory of the market. And what that is they're talking about right now that homes that are selling and selling less than 30 days are homes that are move-in ready, right? And Steve and I have been talking about this for who knows what, 4 or 5 months now, Steve?
Yep.
Yep. So now that's starting to hit headlines. Okay. So what's happening is these houses that are coming onto the market that aren't really move-in ready are starting to go stale and they're starting to take these price reductions that we've been talking about. So if you're a seller and you have a house that's crazy up to date and it's like move-in ready, then you can pat yourself on the back and it could be a good time for you to sell, right? Now, if you have
Yourself a certified hot cake.
yeah, a certified hot cake. That's right. And that's typically there's a third of houses that are selling at or over asking. Those are those houses right now. Houses that need some work, maybe like a roof or a furnace or a hot water heater, or maybe even some cosmetic work. Those are the houses right now that are taking the biggest hit. Okay. And the reason why is because again, prices are high and interest rates are being stubborn right now. We'll talk about those in a few minutes here. But people are really basing their monthly mortgage payment and they're stretching out to their max to the point where some of these people are putting themselves into paycheck to paycheck situations and they're just not going to have that budget for any updates or any huge repairs that are going to happen within the first few years of owning a house. And if any one of you guys are house homeowners, usually this happened to me within the first 6 months to a year, something huge is going to happen. You're going to have to fix on your house, right, Steve?
It's always the case. Even on new construction, there's stuff, you
Yeah,
know?
it's just the way of the way. So a couple points that did come in as far as data goes. Pending sales, they posted their biggest decline since the beginning of March, which is abnormal and atypical for May. But again, last month was a pretty stubborn month for rates, so that's why we're seeing that data hit. And then we're in a second historic low for active listings currently on the market, second to last year of June. So last year we had super tight inventory. If you guys can remember, we were like at a 1.2 or a 1.5 months inventory. This year is second to that. I forget exactly where we're at. Here in Metro Detroit, we're right around two. And I think nationwide, we're like right around three, if I can remember that right. So still a very tight inventory in the market, but we do have a tighter pool of buyers just because affordability is so low right now. So if you are a buyer and you have the budget to possibly, bite the bullet and deal with these stubborn rates and high prices for a period of time, you could have an opportunity for yourself to get a deal. Would you agree, Steve?
Yeah. I actually saw in the local news here yesterday that there was 1.4 months of inventory in Metro Detroit right now, which I mean, who knows? Who knows? Everybody's got a different number depending on where you get the information, but it is despite inventory levels being higher than they were last year, it's just still very tight in the market. And something that that I look at too is, people talk about how do you fix inventory, right? And they say like, well, the foreclosures are coming, and it's not because, and I've said this on here before, anytime a family moves, they have to have somewhere to go. So if they foreclose their house, that family still requires a residence to go to. So that doesn't create inventory, that just creates a transaction, right?
Right.
And so how do we create inventory? It's builders. And so if you look at it, so we got housing starts for May, which reported a 1.277 million annual pace. And that's actually down. That was less than estimates, and we're down about 54,000 housing starts. So that's like actual permits pulled for new homes to be built. So not only are we seeing like rates being stubborn, and in the past year, that's hurt the used home market, right? Because that's where your consumers have to come to mortgage people get their loans. Where for the past year or year and a half, builders were able to subsidize rates with their own revenues to basically buy down rates and offer people buying their homes below market rates. And now it's the point where that it doesn't make sense necessarily for the builders to do that anymore. And so as people are seeing less incentive to buy these homes, we're starting to see housing starts slow down, which again, it doesn't help our inventory problem at all, which will be kind of interesting to see. I think that's why, even though we're starting to see less houses, some houses going for less than ask or less bidding wars or like marketing times increasing slightly. I think as a homeowner, it's important to remember, despite how the news makes this look, especially in an election year, um, this is a great time to be a homeowner. This is a time when you can see, this home appreciation compounding on a property that might be, say you buy a $500,000 house and that's going up, 6 to 7% a year in compounding. There are very few other vehicles that you can have a $500,000 compounding at 5 to 6% and only have $25,000 of your own money in that transaction. And the rest, the bank is willing to let you borrow. So kind of an interesting time when you look at it from that perspective.
Yeah, absolutely. What else about rates is going on, Steve? Anything
Yeah,
exciting?
as far as rates go, we're kind of in this channel. We finally clicked a hair below 7% as like your national averages, which is down probably 3/8%, almost a 0.5% from where they were in March. So we have seen a lot of easing in rates. It's been very slow, and it's because it's conflicting information. So the markets and the Fed trade on data, and some of the data we get is very good, and it shows that a very strong economy, and it shows a very strong labor market and a very strong wage growth environment. And then you get other reports that measure that in a different way, or they survey different providers, and that information comes in worse. So it's kind of a six in one and a half dozen in the other when they start looking at the information. So that's mostly related to the employment market. We've seen a lot of the inflation data has been better than estimates. So our inflation is coming down while it's tiny, it's tenths of a percent at a time, is coming in below what economists in the market expect, which has been good for rates. So we are in now this under 7% channel. And so now what are we going to watch for, right? So we're continuing to watch unemployment claims. Those actually came in this week at 200 and I think it was 238,000 for last week. And they were expecting 235,000. So we had more people file for unemployment than we thought. More people remained on unemployment than we thought. So that's a big measure that we watch for weekly. A lot of housing information today, so that's not necessarily big market movers. Overseas, we saw the Swiss Fed. They lowered their interest rate. We've seen some more interest rate decreases abroad. So we're starting to see some of these other places and these other modern first world economies starting to ease some of their monetary policy, which has been good. So for us, it's just a matter of getting a couple more good employment reports showing that the labor market is softening some, and we continue on this same trajectory of inflation. And we should probably late summer, early fall, start to see the Fed make some moves on lowering their rates. So we're still hanging around just below 7. One other thing that that's kind of interesting is that the 10-year Treasury has been dropping a lot, but mortgage rates or like mortgage bonds have not. So mortgage bonds have kind of been underperforming. And that is not uncommon during these times of transition because these markets are on such a hair trigger that they can go up really fast or down really fast. Nobody wants to miss. Nobody wants to be early. And so you'll see some of these markets underperform until they really got some solidarity in the data. And then we'll start to see rates follow. So things are building, and hopefully we'll continue to see that improvement as time goes on.
Got it. Awesome, Steve.
That's all I
Well,
got.
perfect. We will see you next week. Thanks, guys. I appreciate you.
All right, man.
Bye.